Sensex touching 50,000 today, the 50,000 mark for the first time. An incredible day at the market. Yes, there are bound to be variations, but what is sustaining this boom, and is it here to stay? We're also joined at this stage by Sunil Sanghi, the founder and CEO of Nova Dhruva Capital Private Limited, Anand Narayan, the senior India analyst, Observatory Group at FICCI, and Harsha, the CEO and Whole Indie Grid Investment Managers Limited. Thank you very much for being with us. Mr. Shanghai, let me come to you first. There is market sentiment. There are a whole lot of factors which affect the stock markets, the Sensex, but underlying it is the strength of the economy. Going into the budget, what do you want to see to ensure that that underlying strength, which has been missing for COVID and for other reasons, is restored?
Yeah, that's a very good question, Vishnu. So the expectation from the budget, if you put this in the context as to under the circumstances in which this budget is being prepared, there are three very important fundamental issues which are impacting the budget. The first, which we all know, you just spoke with Ashish on this, on the fiscal front. The resources would be constrained given the state of the economy, and the expenditure would be higher. So what is the view we take on the fiscal side? I would suggest we should be fiscally prudent because that's a good long-term strategy. It may have a short-term pain, while we can look at the fiscal deficit target in the medium term, but we should be fiscally prudent. The second, and again, the related part is that how do we kickstart the economy, which is through the investment increasing the investment, and that's the time-tested formula. How do we make that investment? I think there are innovative areas where we invest in asset and churn those assets. For example, NHAI is trying for InvIT, and there are other ways of in boosting the investment. And the third, how does the government get the resources? The two ways of getting resources, tax and non-tax revenue. I think the focus should be on the non-tax because we know very well that if we increase the tax to GDP ratio necessarily does not increase. So we should actually focus on non-tax revenue. There are a host of areas where we can actually focus on for the non-tax revenue. If we do these three things, I think market will definitely take it very positively.
All right. Mr. Anand Narayan, there's been a lot of FII activity in the Indian markets, and that's welcome, particularly at a time like this. Also, strong global cues, a change of leadership in the United States, the battle against COVID. A lot of people would say we've turned the corner, at least in our country we have. But is there also a fear perhaps that this is a bit of a bubble, particularly as far as FII involvement in the Indian markets is concerned, or do you believe this is here to stay, at least for the next little while?
Well, thanks for having me, Vishnu, and you're absolutely right. There's been this flood of liquidity which has hit our markets. We've seen about $33 billion of FII flows coming in over this fiscal year alone. It's touched all-time records in terms of FPI inflows, and that's clearly holding up the market. The valuations in terms of price to earnings, the regular stuff that you look at to see whether it's fairly valued or not, clearly indicate the market seems to be on the expensive side at this point in time. And also, as you pointed out with your earlier speakers, the economy itself is not doing that great. So there is a divergence between what's happening on the ground and what the asset markets are showing up. Now, can this last, Vishnu? It can, because after all, it's are not, we should stop pretending that markets are portending where the economy is headed. And we should also stop pretending that the economy is going to portend where the markets are headed. The reality is markets are demand and supply. There is a flood of liquidity coming in right now. There is a lot of money in the US, which is the amount of money with actual people in terms of money supply has really grown by about $4 trillion this year because of the fiscal pump which has happened, and that money has to find some assets somewhere. So there is money coming in. If you have enough money chasing assets, you can drive up the price of coal to a diamond. Here's the good news though, Vishnu. We are hoping that the economy catches up to the market rather than the market settling down to where the economy is right now. And that's where the opportunity is as far as the budget and beyond is concerned. A lot of good opportunities for India. Hopefully we grab them.
Okay. Mr. Shah, small caps and mid caps have been underperforming. And therefore, can there be any realistic expectation of the market seeing a more broad-based gain in sessions going forward?
So thanks for having me, Vishnu. I think, see, as Anand said, and even earlier speakers said, markets are, or the rally is a function of liquidity, and the liquidity is abundant in the markets right now. On the economy side, I think we do see green shoots. So I'm siding with Anant in hoping that economy is catching up with the markets, and we'll see a lot of these benefits trickling down to small caps and middle caps, which is representing a wider set of economy. And then as you see the results and the numbers for different sectors, whether it's utility, consumers, paint, real estate, all of it, as long as you see it on a quarterly basis, numbers have substantially recovered. So.
Okay. Mr. Chauhan, just one broader question to you. It's been a spectacular rise of the Sensex over the last 30 odd years or so. Despite, I mean, the economy opening up, policies at that stage, spectacular drops, several disasters, but again, the overall trajectory of the market has been incredible. The fact that we are at 50,000 today, some would say is an indicator of a broader resilience despite the period that we find ourselves in now. Would you say that this is an indicator of just sentiment, or is there something deeper which backs this sentiment despite, you know, the mess, let's face it, that we are in now?
That was a question for
Ashish,
go
ahead, sir.
Right?
Go ahead, sir, Mr. Shanghai.
Okay, good. So look, this is an interesting part. So you know, there's one way of looking at the Sensex where it was at the bottom when, you know, 26th of March, when the Sensex went down completely, significantly in the fear of COVID. And now it has bounced back, and you can actually term it as more than 100% rise. Whereas the right way of looking at it, as you rightly put it, is more on the long term. Even if you take it for the last 1 year, the growth in the Sensex is around 20%, both Nifty and Sensex. The market has gone up by around 20%. And the point which Anant mentioned is that it's also partly driven by extraordinary liquidity which has come into the Indian market, domestic as well as the foreign inflow. But there are two other factors which we have to keep in mind. This market is driven by the interest rates have gone down. In the same period of last 1 year, the interest rate has gone down by more than a percentage point, and the inflation is under check. The other part is that rupee has actually behaved really well. So with all these factors, the market growing up by 20% is really reasonable if you compare with the long-term view.
Okay.
The other area, which is, you know, the other point which you had earlier mentioned about, the corporate performance, particularly for this quarter, the, you know, initial indications which are there are three factors which are coming out to be very, very clear and very interesting. One is productivity has improved, which means the corporate have taken some kind of rationalization on the cost side. So the productivity has improved. Interest costs have gone down for the corporate, and the capacity utilization has gone up. Putting all of this together, if the corporate performance improves, I think the market growth of 20% in the market in the last 1 year is reasonable.
All right. Well, I'd like to thank you all. Just one final question. I've got 30 seconds left. So let me just go across to you, Anant, one more time. There are a lot of people looking to invest in this market, and it's not an easy decision to take, given the fact that incomes are lower now. Sometimes incomes have disappeared. The economy is on the rebound, but even nowhere close to. So there's not very much disposable income. So what would your advice be to somebody new, perhaps somebody young, looking to get into this market, watching this program and saying, wow, I can really get a return at some stage? What is your message to them?
Well, Vishnu, I hate to be a wet blanket, but I'm going to be one. Look, it's a time to be careful. You know, it's easy to get exuberant and irrationally exuberant in times like this because of the liquidity. But one quick point in what happened in history. You know, before the global financial crisis, Vishnu, we saw Nifty at about 6,100, 2007, okay? It crashed after that below 3,000. It came back to about 6,100, the previous peak in 2010. And by the way, we saw extremely robust FII flows coming in through at that point in time as well because of the global liquidity. And then it stayed at that 6,000 level, or it didn't see 6,000 again till about 2014. So, you can have a liquidity-driven rally going through, but unless the economy actually picks up, and at that point of time, the economy failed us. We didn't create jobs. We saw inflation. We saw a current account deficit. So the onus is on us right now to repair the economy, to create jobs and output in India. Okay. If we grab that opportunity, this valuation is absolutely justified, as Sunil mentioned. But it's a big if. And we can't take that for granted. Unless we get jobs and output in this country, the valuations might be, unfortunately, a bit of a bubble. This is a time to be a little careful.
Mr. Shah, last word to you. Would you agree that we may be in a bit of a bubble now, and that therefore investors need to be careful?
So I think more than predicting a bubble, I would agree with Anant in saying that they are already at a higher level. So even if there is no burst, you still don't get return, even if the markets stay over here for next 5 years. Right? So looking that into mind, returns from here begins at what level you have entered. So you're already entering at a substantially higher levels. So one needs to be substantially careful and conservative on expectations of how much returns can one generate from here.
All right. I'd like to thank you all very much for joining us. It's still an exciting time at the market, and I think we are all agreed on how long will this last, and will it be backed by something substantial? And let's see what the budget really brings in that regard. Thank you all very much for being with us.